Sam works at FounderCatalyst. He runs FounderCatalyst. We're partnering with FounderCatalyst on a number of masterclasses and events. Sam and his team already work with quite a lot of our founders and have really great feedback. I know that he's a very good source of helping founders get their funding and their legal sorted, and I think you end up probably doing a bit more than that as well. So anyway, let's get started. We have read through all of your challenges. When you registered, you said what your biggest legal challenges are. We're going to make sure that those get answered as best as we can, but we're also going to be taking live questions from the audience.
Yeah, it's great to be here again, Emmy. This is our second session, actually. The first one was all around SEIS, EIS, so it was literally talking everything about funding using SEIS, EIS, what the rules are, how you go about getting it, why investors care, how to use it, and everything else. First session was tax. This one's legal, which are both fairly dull, aren't they? And the third one that we're planning now, that we're planning for the future, is going to be all around investors and how to find them, how they think, and stuff like that. So that one gets slightly more exciting than tax and legals. But I personally think this is a necessary evil.
It's something that's so important, legals. And if we can help more founders understand it and make it more simple, then, you know, that's just fantastic.
So in terms of what we're going to cover today, I'm going to do a quick intro on my background and what FounderCatalyst does. We'll talk around the 3 different ways of closing a funding round in the UK. We'll talk around the key documents. So what does a funding round look like in terms of documents, where, when, and how, and what do they do? Then we'll look at some of the legal terms that, or lots of the legal terms that are in play in a funding round. And we'll do this using the term sheet. We'll walk through why you have a term sheet, how to get investors off the fence using it, but also what it contains. And then we'll talk about some toxic terms. So the things you should watch out for in a funding round. Without further ado, let's go. In terms of background, so I'm an exited founder. I became what I call an accidental entrepreneur in 2013. So the business I'd worked for 15 years just disappeared like that overnight. It was 450 million revenue, 2,500 employees. I thought it was going nowhere, and it literally went nowhere. So January 2013, I started my own business. That went really well. We went from 0 to nearly 30 million revenue in just over 3 years. We picked up Sunday Times Tech Track, second fastest growing company in the UK, and Financial Times, 17th fastest growing company in Europe. At which point, loads of private equity started sniffing around the business. We accepted an offer, and as part of that offer, I exited the business. It was September 2017, and I found myself unemployed, and I started angel investing. And over the last 6 years, I've got 32 investments, an average of about 25k, so just over $750,000 now deployed. And I've got a really strong preference for early stage businesses, SEIS, and I'm sector agnostic. So I've got everything from the most comfortable male underpants. I've invested in a business that make those, through to sort of AI and SaaS type businesses too. And I kept bumping into loads of founders that had really great ideas, but just had no idea how to do a funding round. They didn't understand SEIS, EIS. They didn't understand advance assurance or term sheets, but also they didn't understand how to play the game. A really painful information asymmetry between the kind of what an investor understands, and investors know how to play the game. They've done it lots of times. They know how to play the game properly to their advantage. And founders who probably are only ever going to do a couple of funding rounds, 1 or 2 in their life, and they don't know how to play the game. So I thought, actually, I'm going to do something about that and ensure that founders are as well informed as investors on, you know, how to play the game, and therefore how not to be taken advantage of. So I started FounderCatalyst. Very quickly, we do 4 things. So we offer a whole bunch of free stuff on our webpage, things like term sheets. You can produce your own customized term sheet within 10 minutes on our platform, things like employment contracts, advisor agreements, cap table modeling tools, and lots of other bits and bobs. Secondly, we help people get SEIS, EIS advance assurance. We've got a brilliant track record, so we've got a 0.3% failure rate there, and we don't charge for that. It's free when you commit to a funding round with us. We do legal funding round paperwork, and you'll see later how many documents there are in our full price round. We produce all of those in a SaaS platform. You can open and close a funding round in literally 10 minutes. We've got a video of that on our website, and we are by far the most cost-effective way of doing a funding round in the UK. And finally, we make introductions between our customers and potential sources of funding. So what I wanted to cover first is just to take a step back and cover the real 101s on what we're going to talk about today. Going back to very basics, we're going to talk about what it means to do an equity funding round. And what is an equity funding round? Essentially, it's selling shares in your company. So you are selling just shares in your company. It is very unusual for you as a founder. This is lesson 101. I have to correct people on this lots of times, but you'll never sell your shares as part of a funding round, or very rarely. When people are investing under SEIS, EIS, as they will in an early stage business, you'll be creating what are called newly allotted shares, or just magical new shares that your investors are buying. And the reason for that, there's a couple of reasons. Firstly, if you were to sell your shares, there could potentially be a tax impact of that, and that could be unpleasant for you, the company, or the investor. But secondly, if your investors want to make use of SEIS and EIS, you need to create newly allotted shares. You can't sell your shares. And this does create an interesting challenge. Lots of founders think, I've currently got, say, 10 shares in my business, and I'm going to sell one share, and therefore my investors will end up with 10% of the shares, which kind of makes sense if you think of it like that. But actually, because you're never selling your shares, you're creating new shares. Before a funding round, you've got 10 shares, you sell one share, then actually at the end of the funding round, you've got 11 shares. So your investors actually end up owning 9.09% of your company rather than 10% you would expect. The reason I'm showing this diagram, and I'm not going to talk through in lots of detail, but there's a really interesting dynamic that happens as you reach more mature levels of funding. So you start a business, you bootstrap, you might take friends and family, all the way around to VC investment. In early stage funding rounds, so everywhere from friends and family through to usually angel networks, you as a founder will be responsible for producing all the legal documentation. So your investors, they won't want to produce any docs. They will expect you to produce the term sheet and you to produce all the funding round legals. And then when you come to crowdfunding, Seedrs and Crowdcube, they have their own documentation type they will usually force you to use. And then SEI funds, strategic investors and VCs, they will, even if you've done other funding rounds and you've got existing shareholder agreements or whatever in place, they will force you to put those in the bin, and they will give you brand new documents that are much more aggressive and much more beneficial to the investors. So you'll put your documentation in the bin. But for early stage funding rounds of friends and family, angels, and usually angel networks, everybody will be expecting you to produce the funding round legals, which is probably terrifying. If you've never done a funding round before, you probably don't know what legals you need. You certainly don't know how to write them, and how do you achieve that? There's a couple of options. There are platforms like FounderCatalyst, and we produce every document you need to close a funding round. Or you can end up you can just use a normal lawyer. The problem with lawyers, and I found this myself, the first couple of businesses I created, when I exited, I used a lawyer to produce our documentation. And every time you want shareholder agreement articles and all of the other documents, you end up having to spend £10,000 with a lawyer. So hence why FounderCatalyst is great, because you can produce your own documentation. It's your documentation, so you get to choose the settings and the rights and protections you're giving investors, and it's £1,500. It's nothing like the £10,000 or £15,000 you'd usually pay a lawyer. If you are in these early stages, from friends and family to angel networks, you're going to need to understand in some detail what the legals look like for a funding round. So what type of funding rounds are there in the UK? Actually, there are 3 common types of funding rounds. In other countries, in America, you get safes and options and warrants and convertible loan notes and lots of exotic sounding instruments. But in the UK, at least at an early stage, you virtually never see any of those documents. And that's because all of the things I've just mentioned just aren't compatible with SEIS and EIS. You can't use an American style safe, and you can't use convertible loan notes. None of those things are SEIS, EIS compatible. At an early stage, your investors are almost certainly, as long as they are UK-based and they're individuals rather than companies, they're going to want to make use of SEIS, EIS. It's the thing that angels look for in the UK. And therefore, you can't use any of those more exotic types of documentation. So you've got 3 choices. The first choice is an advanced subscription agreement, or an ASA. That's really useful to close an initial set of investments before you've got a valuation in place. Now, personally, as an investor, I absolutely hate ASAs. I've got an article which I will share at the end of this session, which talks through the issues and challenges with ASAs. From a founder's point of view, they're pretty founder friendly. but the paperwork and the amount of paperwork is painful. You need to authorize an ASA, you need to issue them, and then at some point, usually no less than 6 months later, you need to convert them to equity. So it's a 3-step process. It's just a bit painful. And from an investor point of view, there are lots of rights and protections I don't get for at least 6 months until the ASA converts to proper equity, and therefore I know lots of investors that just refuse to use an ASA. And then you get something called a priced round or a normal funding round. So this is where, say you're raising £500,000, you get all your investors lined up at one point and everybody had signed the documentation. There'd be lots of documents flying around. Don't worry, we manage that. But yeah, it's what's called a price round. The challenge with the price round is, if you're raising £500,000, but you've got 200 committed, actually you want to take the £200,000 off the table and then continue to raise the other £300,000. And a price round doesn't really allow you to do that. You've got to herd all of your cats to one point. Obviously, if you're taking 6 months to get to the point of raising, you're not getting the money in earlier, so you can't start spending the initial money to further your business. And there's a chance, if you're spending 6 months to fundraise, that your investors will get bored. Your early investors you'll get something called investor attrition, where they'll find something else to invest in, or their circumstances will change. So the third way kind of solves lots of the problems I've just mentioned, which is agile investment. This allows you to close your initial price round at, say, £200,000. So your investors get proper equity, they get all the rights and protections they would expect, and they can claim their SEIS and EIS relief from that point. But the agile investment then allows you to raise the remaining 300,000 over the next period. So you can raise that over the next year or whatever. You can raise 50,000 a day or whatever it happens to be. And it's a really elegant way of raising, because actually each of your investors, from the point of you closing your price round, you're just issuing them a 3-page documentation. All of your existing shareholders and investors have already agreed that you can raise the amount, so you don't have to worry about shareholder resolution or investor consents or preemption process with them. You're literally issuing a 3-page document, your investor signs it, they send you the cash, you give them a share certificate, and you are done. So it's a really lovely and elegant way of raising. And for me, it's the combination of a price round to take some money up front and get your paperwork in place, and an agile round is absolutely the most elegant way of raising. I've spoken about a price round, so let's look at what a price round actually looks like in practice. This next slide is going to be a bit terrifying. I will walk you through with some pace of what the documents contain, but needless to say, our platform produces every one of these documents and it manages who signs what when, so you don't actually need to worry yourself about understanding the minutiae of this. So what we've done here is broken a funding round into 5 individual steps. The first step is a preparation step. How do you get your advance assurance in place? If you're fundraising in the UK from UK investors, you're absolutely going to need this. It's one of the services we provide. And the reason for mentioning it on this slide is that in order to get SEIS and EIS advance assurance, you need standard things you will already have when you're going to pitch. So you need a pitch deck, a forecast, and things like that. But you also need a copy of a proposed shareholder agreement and articles of association. So in order for HMRC to grant that advance assurance, you need those 2 documents. So actually, even though you may not be closing your investors for 6 months, you're going to need those 2 documents up front so that HMRC can validate that those documents are compatible with the SEIS EIS scheme. You'll then go through a phase of pitching where you're approaching, meeting, and then pitching to investors. And to do that, you typically need 4 documents. You need a pitch deck and forecast that you already have to go through the advance assurance. You will need something called a term sheet, and we will walk through in just a couple of slides what a term sheet is, why it exists, and what it does. And then you'll need the copy of advance assurance from the previous stage. Great. So you've nailed your pitch. You've got investors lined up who are happy to invest. What do you do then? So the first thing you should do is onboard your investors. That is, engage with your investors in a way that keeps the company safe and sound and manages your relationship between those investors. So for me, and on the FounderCatalyst platform, that consists of 3 documents. And every time you invite an investor to our platform, we make sure that every investor signs an NDA unless you specifically waive them signing that. And there's a couple of reasons why that's important. So just providing a pitch deck, your pitch deck should be generic enough so that you're not sharing any details that are either subject to patent or trade secrets or whatever. So the pitch deck should be high level enough that you're not giving away the crown jewels. when you're giving people access to your data room, that will contain potentially more information that is much more commercially sensitive. And we will also be sharing on your behalf details within the shareholder agreement, for example, of existing shareholders and investors. It will potentially have your home address and things like that. So you'll want your potential investors to sign up to a non-disclosure agreement. We also get each of your individual investors, so people that are individuals rather than companies, we get them to sign something called an FCA consent or FCA disclaimer. You've probably heard there's a lot of anger in the founder community at the moment because the rules around the FCA documentation have changed as of the 31st of January. And you now need, your investors have to have at least £170,000 income compared with £100,000 just a month ago. So those rules have changed very recently. We've updated our platform so we ensure that you are checking that your investors meet the new financial promotion rules as published by the government. And the reason that's important, if you don't follow those rules, then there's potential jail time and certainly significant fines. So it's in your very best interest to make sure each of your potential investors sign that. And then finally, we've got the term sheet that we will come back to in a minute. So that's how you onboard and prepare for a funding round. And then there's another whole set of documentation. Again, we produce every one of these that allows you to go through the process of closing the funding round. And this is, again, for a full price round. So an investor will expect to see a couple of kind of background documents, which are legally binding contracts between each founder and the company itself. So the investors aren't a party to these agreements. The first document is a founder service agreement. And a founder service agreement is effectively an employment contract for each of the founders. And it governs the relationship between the founders and the business. And it does the usual thing you'd expect in an employment contract. The next document is an IP assignment. And again, this is between each of the founders and the company itself. And this ensures that all of the IP, whether it's patents or trademark or copyright or know-how or source code or whatever it is, it ensures that all of that IP rests within the business rather than with each of the founders individually. And that's really important because, you know, what happens if a founder gets hit by a bus or there's a disagreement between the founders and they wander off? You don't want your investment in the business to be for nothing if a founder can walk away with that IP. So that's a really important protection for founders. And to give you, I love a good anecdote, to give you an example of why this is really important, everybody probably knows Adam Newman and the WeWork situation. So SoftBank, I forget the exact numbers, but they invested billions, I think it was 20 billion or whatever it was, a ridiculous amount of money. So SoftBank are a VC, they invested in WeWork. The very next day, Adam Newman sent a letter to SoftBank, to WeWork actually, saying that he had trademarked the word we in WeWork, and therefore the company needed to pay him £5 million to license the use of the word we in WeWork after SoftBank just put £20 billion in the company. Absolutely crazy. It's just ridiculous. But that's a really good example of why every one of your investors will expect to see the company owning the IP rather than each of the founders. The two big documents are in a funding round, and I'm going to jump around a bit here so it makes more sense. The two big documents in a funding round are the shareholders agreement and the articles. So the shareholder agreement is a legally binding contract between the company as a party to the agreement as well, each of the founders, any existing shareholders and the investors. And it is like any legal contract, it governs the relationship and how all of those parties work together. And usually it limits what founders can do. There'll be things like restricted covenants, which define what you can and can't do, both whilst you're an employee of the company, but also potentially if you leave, it says you can't set up a competing business, you can't poach staff or customers or whatever, and lots of other legally binding things that investors will want from you. For example, if your investors ask for information rights, which gives you an obligation as a founder to update them on the company progress every quarter, then that would be defined in the shareholders agreement. So really standard document, but very heavy. I think the average shareholder agreement that we produce is 45, 50 pages. So it's a really heavy document. It's legally dense. It's no fun to read. The next largest document is the Articles of Association. And this is the rule book on how the company is run from a formal Companies Act point of view. And it defines how shares are issued, what different classes of shares and what rights are associated with those shares. It details how the board is run and how directors are added and removed and how often they should meet and things like that. So a really important document. And then the other documents just support the closing of a funding round. So the shareholder resolution authorizes the issue of shares and the adoption of new articles and things like that. The board minutes does at a board level exactly the same, and the disclosure letter sits behind the shareholders agreement. Lots of documents that do lots of different things, but there are platforms, including FounderCatalyst, that allow you to produce all of those without worrying about the exact details. And then finally, we shouldn't forget this. Lots of founders get the money in the bank and go, yay, they're focused on growing the business, but they forget there's some post-funding obligations as well. So the first thing you need to do, and we do this for you, is send a share certificate to everybody who's transferred you the money. So when you get the cash in the bank, you issue a share certificate signed by a couple of founders, hopefully, and that gives the investors comfort that they've formally got shares. You then need to file something called allotment of shares, or SHO1, with Companies House. And then we go through it here, but there's quite a convoluted process to go through to allow your investors to claim the SEIS and EIS relief if they've invested under that. And that starts with the filing of something called an SEIS1 or an EIS1 compliance statement. So those are the documents that you will see in a funding round. Let's move on to the term sheet, because we've mentioned this a few times. And the term sheet's a really funny little document, because actually it's signed, you can see here, it's signed when you're pitching potentially, and certainly when you onboard investors, you will ask your investors to sign that document. But actually the vast majority of a term sheet isn't legally binding. And as soon as that document's filed, it's put in a drawer. It's usually, I can't think of any instances when it's been used in anger. So it's a really weird legal document. So let's cover why it exists. Why does a term sheet exist at all? And the reason fundamentally is, as mentioned, the shareholder agreement is nearly 50 pages. The Articles of Association isn't much shorter than that. And therefore, to negotiate a funding round, you could walk through those 90 pages, agreeing every individual point with your investors. Nobody wants to do that. Your investors don't want to do it, and you certainly don't want to do it as a founder. The term sheet distills all of those really important decision points, the rights and protections that you're offering your investors. The term sheet distills that down into a 4 or 5 page document. So rather than trying to negotiate 100 pages up front, you negotiate a 4-page document, which summarizes exactly the rights and protections that you'll be offering your investors, and also details what company are people investing in, who are the founders of the business, what does the existing cap table look like, what rights are associated with each share type, and things like that. It's worth saying up front that you, as a founder in early stage businesses at least, you are responsible for producing the term sheet. So your investors won't produce this, it will be you. The document is mostly not legally binding. So there are a couple of parts in it around no fees and confidentiality that technically are legally binding on both parties. But just by you as a founder signing the document and by an investor signing it, nobody's obliged to invest in the business. So you can refuse the investor's cash, and the investor's not obliged to invest in you anyway. So signing a term sheet is a big step forward for you as a founder. It's a signal of intent from each of your investors, but nobody's obliged to do anything. Yeah, don't start spending the money quite yet. Now, the term sheet is actually a useful document to get your investors off the fence. And what do I mean by that? So if I've seen somebody pitch, so I've got in contact with somebody, I've seen them pitch, the next step would usually be to agree the term sheet. If I'm interested in investing, or at least going into due diligence, then I'll sign the term sheet. If I'm not, then I'll usually say, look, this investment's not for me, and therefore I'm not going to sign that document. So it's a nice way of pushing your investors through that funnel. And this document also creates what's called an anchor between both parties. In this document, you are agreeing something like information rights or investor consents, whatever the legal protection happens to be. And you are both agreeing that in this document. It's then really quite difficult, as it's impossible virtually for a founder, and it's nearly impossible for an investor to change their mind. So if you've agreed something is either in scope or out of scope in the term sheet, as a founder, you can't say, hang on, I agreed I would give you investor consents, for example. You can't then say, when you come to negotiate the full documents, we're not giving you investor consents, because it's just completely unreasonable. As a founder, you should try not being completely unreasonable. As many of you will know, if you've bumped into investors, there are some investors out there who are completely unreasonable. And just because they've signed a term sheet doesn't mean they won't try and renegotiate exactly the same thing. But it will make that much harder. Personally, as an investor, I'd feel really uncomfortable trying to change a term I've already agreed in the term sheet. pretty obvious, but worth stating discreetly, I guess, that the term sheet should reflect the long form document. So the 100 pages should be identically reflected in the term sheet. You shouldn't have a promise within the term sheet you're offering investor consents and then that not being present or being misstated in some way in the shareholder agreement. That would be particularly bad form. And the term sheet is signed by one of the founders and one of the investors. The signature, like I say, is not particularly binding other than confidentiality. So that's what a term sheet does. And the reason we're introducing that, firstly, it's probably the first legal document that you will have anything to do with as part of a funding round. But secondly, the term sheet actually contains all of the interesting stuff, all of the stuff that's worth negotiating from all of the other documents. So it's a really nice place to get to understand each of those variables and rights and protections that an investor could ask for. Which brings me on nicely to the next slide. And we're not going to talk through every part of this. That would take more than the hour would suggest. But what I thought, what this does nicely is break the term sheet and the deal terms into kind of bite-sized chunks. So at the top here, the term sheet would typically detail the deal economics. So what's the valuation? How much in total are you raising? What's the minimum ticket size? What's the dilution? All of those things are pretty related. You're going to want to know upfront what offer you're giving to your investors, and your investors are certainly going to want to know. There's a massive difference. If somebody's raising 250K, which is the average raise in the UK for pre-seed, pre-revenue, an investor's going to want to know whether that's a 1.5 million valuation or a 10 million valuation. So they're going to want to know that right up front. So there's no point trying to hide that on a term sheet. They will want to understand the deal structure. So is it a price round? Is it agile? Is it an ASA? And you can see at the top, there are some other instruments that we virtually never see in the UK just because they're not SEIS compatible. But they will want to understand what are the mechanics, how is this funding round going to be implemented. Quite often, investors will be interested in understanding the rights that are associated with their share. Our very strong guidance is that everybody in your business should end up with ordinary shares, at least at the start. So founders, any existing shareholders, any family and friends investors, and your arm's length investors should all have ordinary shares. There's lots of reasons for that, but it just, A, it keeps the paperwork straightforward. B, if you have slightly differing share rights, then it's easy to create something called a preference. And that's a really awful way of destroying your investors' potential tax reliefs. But sometimes in specific cases, you want to have a specific investor who, you want to drop voting rights or whatever for. And that is possible, but fairly unusual. The 3 rights that are associated with every share class, just to dive into that detail. So firstly, there's a dividend right. Every share class can either have the right to dividends or not. Capital right, so when there's an exit, should that share class participate in that exit benefit or not? And also voting right. So you can have lots of different share classes with lots of different permutations. Very strong guidance from us is just to have ordinary shares for you and your potential investors. When you get to later stage investors, then it's fairly normal to have ordinary shares or preferred shares, or you can call them whatever you like. And they will give enhanced rights to people who hold those shares. So preferred shares may mean that there's a liquidation preference and your investor take their money out first, or they may get enhanced dividends or whatever it happens to be. It's usually not in a founder's benefit. When you've taken on later stage investors, it will always, different share classes will always exist to give your investors additional rights above and beyond you. You've then got how the investor deal fees are structured. For virtually all of our customers, there are no deal fees, so you can ignore all of this. But if you're working with an SEIS fund or whatever, there will be fees all over the place. There'll be fees to pitch. There'll potentially be carry fees on your investors. There'll be a success fee where you have to pay 5% of any money raised, and potentially monitoring or investor director fees where you have to pay for somebody from the VC or fund to sit on your board. None of which is ideal, by the way. So hopefully in your first couple of funding rounds, there'll be no fees and that will be straightforward. The term sheet will detail what your existing cap table is. What is a cap table? It's simply like a spreadsheet or a table showing every investor, how many shares they've got, what share class those are, and how much they paid for them usually. Our term sheets include those by standard. And then there'll be, as we mentioned, a couple of binding terms in the term sheet, whether there's confidentiality, whether there's exclusivity, which you should never ever give to angel investors, but for VCs, that's fairly standard. And then whether legal costs are being covered. Usually it's every party pays their own legal costs, which is straightforward. So that's the boilerplatey stuff. And then you get some decisions on what rights and protections are you going to offer your investors. We'll cover this in 2 slides. So on here, I'll talk through the really standard stuff, the stuff that every investor will be expecting. Then you've got the stuff that's kind of 50-50, whether investors would expect it or not, and whether you offer it or not. And then on the next page, we'll talk about some toxic terms, which are the things that you really need to watch out for. Some of these may come as a surprise to some founders, and some founders just very much dislike some of these terms, but they are ridiculously standard. And yeah, happy to cover any of these in the Q&A if you want to know why they exist. The first one, and probably always the most argumentative with founders, is around founder vesting. And this will define, if you take on investment today and you leave the business tomorrow, every investor, founders probably won't agree, but every investor would agree that it is unreasonable that you've just had £250,000 into your business and you can quit tomorrow and still own 50% or 100% or 80% or whatever it is of the business. Every investor would think that is completely unreasonable. Now, if I were in a founder's point of view, I'd want to keep as many shares no matter what happens, but that just isn't the way the game's played in the UK. So founder vesting is very standard, and the best realistically you can hope for as a founder is pushing for the best terms you can, pushing against a cliff, which means you don't have to be there at least a year to keep your shares, and also have the vesting period as short as possible. So 2 years rather than 4 years, for example. But do not be surprised that every investor in the world is going to expect founder vesting. It's just reality. We then get some really standard stuff. So preemption rights, for example, this is documented in the Articles of Association. And preemption rights give, when you're raising your next funding round, if you hit one, they give your existing investors the right but not obligation to participate in the next funding round. There are lots of reasons for that we don't have time to go into, but it's a really standard protection for your investors. And it means that if you've done a funding round and they own 5%, then they get the right and the next funding round to keep at that 5% by investing at the same valuation as the future round investors as well. Really standard stuff, and it would be very unusual to see that not exist. But drag along and tag along. So actually one of these is a founder protection, one is an investor protection, usually. So drag along is usually a founder protection where this gives you the ability, imagine you've started your business, you've got to 30 million revenue after 4 years and you want to sell the business. Without drag along, you could potentially have the situation where somebody who owns 5 shares in your business, so a tiny percentage, can stop you from selling the business. That would be a ridiculous situation for everybody involved. So there's this concept called drag along, which means that the founders can drag, hence why it's called drag along, drag an investor through a sale process. Johnny, who owns just the 5 shares and is refusing to sign the documentation, you can force him to sell his shares in your business at the same rate as everybody else, so you're not disadvantaging him using something called drag along. So drag along is, A, it's ridiculously standard, it's in every paperwork that I've ever seen, but B, it's actually a founder protection to stop one very small minority shareholder from blocking the sale of a company, for example. Tag along is the opposite, and this is very much an investor protection usually. This means that if the founders all decide to sell all of their shares and 75% of the shareholdings are being sold as part of a transaction, that the investors can tag along with that transaction rather than being left in the business and having an incoming owner. So that is a very standard protection for investors. Again, I've never seen that waived. It is just ridiculously standard. And then you get a normal bunch of contractual stuff. So restrictive covenants we've touched on already. This prevents a founder from creating a compete. Imagine a founder they leave the business. The restrictive covenants prevents them from creating a competing business and poaching staff and poaching customers, that kind of stuff. Very standard. We then get some optional. Some investors will force you to create an option pool before a funding round. Some investors, and this one I can't get upset about from either a founder or investor basis, but some investors will want information rights in your business. And usually this is an obligation on each of the founders to produce a standard update 4 times a year to each of your investors detailing how things are going. Yeah, some founders push against that. Personally, I don't know why. I think quarterly updates is a very reasonable thing for an investor to ask for. The much more contentious is around investor consent. So investor consents are where there's a list of prescribed activities that need you to ask each of your investors to consent to. So things like raising more money or closing the business or changing accountants or changing the name or There's some pretty fundamental things that you may want to do to your business. In order to do those, if investor consents are in play, you need to ask each of your investors, and 50% of the shareholdings of those investors need to consent to the action. If they don't consent, then you can't undertake whatever that action is. Lots of founders think they want free rein to do whatever they want in the business. They don't want to have to ask investors permission, and I can understand that. On the flip side, investors will want certainty that you're not doing some fundamentally important things to the business without them agreeing. To give you a bit of a war story from my recent past, I invested in a business 5 years ago, and I just found out by accident on Companies House that business had closed. Nobody told me they were closing the business. Yeah, it's ridiculous, really. If I had information rights and consent, then at least the founders would have had to tell me. Now, it's common courtesy to do that anyway, but that's an example of why lots of investors will ask for those consents. Very quickly, because I want to get into the Q&A, let's just look at some toxic terms. You won't see, hopefully, any of these in early stage funding rounds. If angels are asking you for any of these, that would be really rare, and it would require, firstly, a sophisticated angel, but also, yeah, they would be pretty brazen to ask for any of these. Where you will see the items specifically in the SEIS, EIS compatible are some of the SEIS funds. The terms you will get off of SEIS funds are usually more aggressive than you will get from angel groups or individual angels. And they may include things like a liquidation priority. They may force you to capitalize your director's loan account, which is particularly painful. Lots of founders put, £50,000 into the business with the intent of paying themselves back when the business is profitable. What this capitalization of loans means is that you are effectively, your loan gets turned into equity at the same valuation as your investors. So it's really painful. No normal angel will reasonably ask for that, but some of the SEIS funds will. You could then get to the really painful stuff, which is not SEIS, EIS compatible. This is only the domain of VCs. And these are things like anti-dilution. So shares, if you have a down round, that protects that specific investor from being impacted by that. Even worse, you get non-diluting shares, and these are really awful. They prevent somebody's shares from being diluted. And yeah, there's some harsh, even for VCs, there are some even harsher terms. Hopefully, you won't hit any of these over the next few years. They're your first few funding rounds at all. But if you want to discuss any of these one-on-one, then please do book a session. So that is all I had hoped to cover in this session, and excited to get into the Q&A.
Fantastic. There was a lot of incredible content there. So thank you for that. That sounds like such a great idea, doesn't it? Because you've got your SEIS, you could go to a fund and they could just give you, rather than you having to go around all the angels, but actually what you're saying is then the terms associated with that and the fees and the things that they're going to charge you take away the benefit.
So we've got an article on which compares what normal looks like for individual angels, private equity club and angel networks, and then SEIS funds. And if I were a founder, the optimal place for me to go would be to the private equity club and angel networks. Their fee structures are usually pretty good. They'll take 5%, but that's compared with funds, that is good. Yeah, and their terms are much, much softer than the SEIS funds. The SEIS funds, they're professional investors who know how to play the game, and they will, for example, take 10% fees. They'll force you to capitalize your director's loan account. They will just push every single angle they can in order to maximize the benefit for them.
Interesting. Thank you for that. That was very interesting. If you identify investors who wish to invest now before the tax year and have yet to apply for EIS, but intend on raising more, what is the best way to do this? So if you identify investors who wish to invest now.
You've still got time. So the average response time from HMRC is 2 weeks. We can get an advance assurance application in today, and hopefully by the middle of March you'll have this. ASAs are a really bad way of solving this problem, actually, because if I put £10,000 into an ASA today, it won't come out of this tax year anyway. It will come out of when the ASA matures into equity. So it will be coming out of next year's tax. So yeah, ASAs are a really bad way of solving this. The straightforward way is, firstly, get your advance assurance in today. And secondly, just do a mini price round. We can get you set. We can get a funding round closed in the next half hour for £50,000 or whatever. The person will get their shares today, which means it comes out of this tax year. And then we can do an agile round to mop up stuff into next tax year. So yeah, ASA feels like the right answer. In reality, it's a bad solution for that.
You make it sound so easy. Just wrap it up half an hour, get the money in, it's all done. I love that though.
Yeah, and that genuinely is the reality. Now, the hard part in all of that is herding cats, is chasing your investors.
Getting the money in.
yeah, the legals and the process is ridiculously straightforward.
That's brilliant. Can a founder add to their existing investment after EIS approval and benefit from it?
That's a really good one. So under SEIS, the answer is a flat yes. Under EIS, the answer is it depends. So there is an SEIS and EIS are usually very identical, are usually pretty identical. This is an area where they diverge. Under EIS, if you've previously invested outside of a tax relief scheme, so if you've invested outside of SEIS, EIS, you then can't make use of EIS. If you've invested under SEIS and then invest under EIS, that's fine. But if you've invested as a raw shareholder without any tax scheme, you then can't make use of EIS. That's a real corner case of the EIS legislation.
I didn't know about founders benefiting from EIS and SEIS. So technically, when you put your money into the company initially, you can put that in. If you get SEIS, if you have SEIS, you could put that in.
Sorry, this is a question. I thought this was a question on investors. Yeah, it's even more complicated. So that's the investor answer.
Oh, yeah, sorry. Because he said, can a founder add to their existing investment after EIS approval?
With some caveats, yes. Now, it depends what percentage you own. It comes down to this 30% for you and associates ownership. It's sometimes, yeah, it's very situation specific. And there are ways that a founder can make use of SEIS. I alluded to this in the last video, that a founder can make use of SEIS and EIS themselves. In this case, it's very specific to what percentage they own and how they got their original shares as well.
I think we can share the link to that video with this one. So if anyone didn't get the SEIS, EIS one, it's really, really valuable. A safe's legal in the UK. I appreciate they cannot be used with SEIS and EIS, but can they be used for future raises?
Yeah, I know safe ASAs, they can all be used. There is a version of a safe that is legal under UK law. Now, why you'd want to use it is as a founder, why you'd want to use it, I have no idea. But technically you can. And I guess the only time I see them are American investors wanting to invest in UK companies. They can't make use of SEIS, EIS, that's irrelevant. And American investors are very used to the safe as a concept. Whereas for UK founders and certainly for UK investors, they're very rarely seen. But yeah, legally, they're fine.
Cool. Why do priced rounds have to be done together, for example, full 500K and not take money in?
Yeah, so you need to, a priced round is by definition, everybody signing all of the documentation at the same time. The old school way of doing it would be wait until you got all 500K committed and take that. By using a price round coupled with an agile round, you get the best of both worlds. So if you've got 100K on the table, you can take that under the price round. The benefit to everybody for that is all of the documentation gets in place. So you get shareholder agreement and articles, all your investors get their rights and protections. And then after that, and we do two for the price of one, I'm not trying to sell anybody anything else. But after that, you can then do an agile round. So you can take the 100 and then raise the rest of the 400 in an agile way. And that gives you all the benefits of a price round coupled with all the benefits of being really agile. So yeah, you just can't do it all under the price round. And it's all about this signing all of the documents at the same time.
Does your term sheet map to the core legal documents?
Absolutely, yeah. So that's one of the problems that we see with, I've seen a few cases where founders have written their own term sheets, which is a really bad idea, by the way. And you can, like I said, I'm not trying to sell you anything. You can get a term sheet within 10 minutes that's customized to your situation from us. But sure, you can produce your own term sheet if you wish, but we make sure that whenever you change a setting on our platform, like adding or removing investor consent, for example, the term sheet matches that exactly, because otherwise you'll be a real pickle.
I mean, the thought of creating my own term sheet, wouldn't know where. It's incredibly stressful.
I've seen it quite a few times, and it's
it must be massively time consuming to try and do that on your own.
Right. Yeah.
But I suppose the other thing is like you don't know what you don't know, do you? So sometimes you don't know that there's options like yours about, and you just think you've got to pay a lawyer like 15K and you haven't got that money. So I think maybe that's why initially people are trying to do it themselves. So how often does a founder end up having to agree term sheets that differ between investors?
Yeah, this is an interesting one. So usually the term sheets will be identical in virtually every other way, because most, at least up to seed stage and usually up to Series A, every single investor will have the same rights and protections. So sometimes what you would do on the platform is say, I'm going to have A ordinary and B ordinary and C ordinary shares or whatever. And you would attach different rights and protections to those share classes. And technically everybody would have the same term sheet. It's just some of your investors would get A ordinary and some get B ordinary shares. there is keeping it simple for early stage investments is absolutely the right thing to do, though. I would personally, as a founder, I'd be going out of my way to offer just consistency across all of your investors rather than have different options. And every term sheet has typically the same valuation, though you can, if you're offering shares to an advisor who's worked for free for a year, you might offer them a 20% discount off of the existing valuation or whatever. But I would be aiming to keep the term sheets as identical as possible.
So can these legally binding documents be signed digitally via a platform like DocuSign? I'm presuming maybe they can do that in FounderCatalyst, or do they have to be manually signed?
Yeah, so we do the signing on the platform, so nobody has to go anywhere else. It's just enter your password, agree that you've signed it. Back in the old days of lawyers, things were called deeds, where deeds needed signing and witnessing and all that good stuff. Yeah, all of our documents are agreements rather than deeds, which means that everybody can sign it on the platform. You don't need witnesses. And yeah, they're as legally binding when signed on our platform as they are in real life. Now, if you want, we've got some investors. There's a very high profile investor, for example, who refuses to sign anything on a platform, and you can just download a copy and they can sign as they normally would. But yeah, virtually 99.9% sign on the platform.
So talking about the income to qualify as an angel or high net worth being K now, that's correct. Are there any other qualifying criteria?
Yes. So there are self-certified sophisticated investors as a broad category, and high net worth. High net worth is where the 170K comes in. There's also a gross assets. So you can say I own, and I can't remember the number, it's something obscure, but it's something like £500,000.
I thought, yeah, 430 or 480 or
432 or something, isn't it?
Yeah.
You can say you've got that, and it excludes your own home, because everybody's home's probably in this day and age. But
I didn't know that. So I was thinking about that. I was thinking most people who earn care, you would have thought they would have a home, and like you said, most homes now are
excluded that specifically. And there's also the self-certified, so you can say you're a sophisticated investor, which has some other items, such as you've been a member of an angel group for more than 6 months or whatever. So that's a nice get out of jail. But the problem with the new FCA regulations, they make us ask details of how much, what is your net assets, what is your salary, what angel group are you a member of. And before, people would just sign any old document, and because they're having to think about it a bit more, it's dissuading people from just rubber stamping, if that makes sense.
How would you suggest valuing a business that is very early on? For example, it's only been trading for 6 months.
Yeah, I was going to push valuation to our third video, actually, because it's a fascinating topic. It's been very fascinating for pre-seed, pre-revenue. Once you've got a business which is earning revenue, you can do DCF and VC methods and just EBITDA times a multiple or whatever. When you're raising pre-seed, pre-revenue, none of those things work. So for me, as an investor, I've got a standard approach, which is look at the latest Bohurst averages. By the way, pre-seed, pre-revenue is about 1.5 million. It hasn't really moved for the last couple of years. And then you apply a test to the business, and this is very subjective. Is it in a particularly sexy area like AI or whatever? Has it got multiple exited founders? Have they got proof points or traction? So have they got a product they're selling? Have they got revenue or whatever? So you're applying these, add 100 to this, minus 100K for that. And then you end up at something which feels reasonable. And what does reasonable look like? Unless it's an exceptional business, pre-seed, pre-revenue, it will be between 1 and 2 million, and it will be about 1.5 million. If you're much more or much less than that, you need to, there's probably something wrong with your estimations.
It's 1 o'clock. I'm going to quickly just launch a poll to get a bit of feedback, and then I think we're okay to carry on. So we would just love to get some feedback. How helpful has today been in terms of getting you clarity and insight on funding legals? And also feel free to actually send any direct feedback on this session today to either me or Sam, because we're both super passionate about helping founders better understand how to build long-term profitable, sustainable businesses, and funding and getting your business financed and also getting all the legals sorted is critical to success. Actually, do you know what's so important? The legals. I nearly signed a legal document when I had my business just before I sold it that would have pretty much cost me about 500 grand. And I skated through the document, had a little look. I was about to sign it. I was like, oh, I just don't know, that little thing in there, that just doesn't sound quite right. And I got it checked out by a lawyer, and it was actually could have had a massively serious impact. So I think one of the things that I always think about as well is when you're an early stage founder and you don't have very much money, and also you're trying to do so many things, you can sometimes just think, oh, I'll skate over the legal bits, or I won't worry about that. But actually having all your ducks in a row is so important. Yeah, and I think the feedback has been amazing, and it's been really lovely to have you all here. So there will be a replay. We'll send that through. We'll also send the replay from last session. We will also, Sam, I think you said you might have written an article that was relevant, so we can, I think you've already put.
Got another article I'm just pasting, which is, there's a really horrible story. It's heartbreaking, really, where a young 18-year-old chap had worked for 3 years to build a business. He'd got to the point of getting revenue. Thankfully, not a FounderCatalyst customer. That doesn't make me feel much better. But he took investment using the two angel investors' legal paperwork, and effectively had his business stolen from him. He'd spent, an 18-year-old spending 3 years of their life building something and then losing it is ridiculous. So whether you use us or one of our competitors or a lawyer, just make sure you cover your behind, because there are lots of bad actors out there in the investment space.
I think the other thing is the money can really rack up. So if you're using a lawyer, I know this, I've spoken to people and they spent insane amounts of money because you just don't know what you don't know, and you don't know what you're going to be charged. And that's what I love about you, and you know what FounderCatalyst and some of the other platforms do is, like, you know what you're letting yourself in for, you know how much money you're going to pay, you know what the outcome's going to be. So how do you navigate a funding round when you have some ASAs, some angels, and then also an SEIS firm who wants to produce their own documents? Which documents do you use and when, especially for angels? And what if you've already signed an ASA before talking to them?
So the fund are almost certainly going to force you to use their documentation. So you won't be able to use us or your existing. So if you've got any existing documentation, like a shareholders agreement, that will go in the bin. You will use theirs. The ASA must be disclosed to the investor, so to the fund, and they will build that into their calculation. So actually, that one's pretty straightforward. Now, absolutely look at the terms from the SEIS funds, look at the fees, look at what they're doing with directors' loan accounts, look at liquidation priorities, just understand what you're getting into. And I'll repost it here, but this article talks through different types of investors and what you can expect. And like I say, prior to a VC, the SEIS funds are the harshest terms you can get. So if you've got other options, you might want to look at those rather than rushing to the fund.
I think founders probably don't realize that VCs have all these can have quite aggressive terms, which actually mean that you always hear about these people that end up selling their business and they don't really make any money at all because various things have happened along the way. And I always just think that's so sad. So I think it's just, like you said, it's being super aware of what is in the documents and understanding them and what you're letting yourself in for. What are the best methods of issuing shares periodically for free time spent in businesses by an investor, so-called advisor shares?
Yeah, there's some options here. You can use an SEIS allocation, which is lovely because the advisors can get CGT exemption with a vesting agreement. You can have a non-tax advantage option, which is the next thing we're building on our platform, option schemes, EMI options, and non-tax advantage schemes. There are various ways of doing it. Those are the two most common. Just to pick up on the point you made about not understanding what you're signing up for, and founders getting nothing on an exit. There's a really bad example called FanDuel, which they grew to £500 million. They exited for somewhere near that. And because of the liquidation preferences that the VCs had, firstly, the VCs had investor drag, so they forced the sale of the business and nobody else could do anything about it. But secondly, the VCs had a 2 times participate liquidation preference. So they took all of their money out and all their money out again on an exit. All of the founders, all of the early stage angels and the junior VCs, they didn't get a penny out of. I think it ended up being a £350 million transaction. Nobody got a penny other than the 2 VCs. It's a really interesting case study on how VCs work specifically.
So we need to be aware of that. What is regarding the timeline, fees from start to finish, and what is expected from the founder in order to start? Yeah,
it depends how you choose to do it. But if I talk through the FounderCatalyst fee structure, it's £1,500. We don't charge a percentage of your raise. There's no SEIS fees. Yeah, that's literally all you pay. And to be flexible, we can do half on commence and half on completion. So we can be really flexible. Other providers have different fee structures, and as with everything, some people charge a percentage of the raise, which for me, if you're raising 100k or £1 million, it really doesn't matter. it's exactly the same work from us. So we're just flat fee. It feels predatory to charge people based upon a percentage of race.
Very interesting that actually, because I think that's how a lot of lawyers do it. They charge it on a percentage. And what is expected from the founder in order to get started? So I suppose that's what does a founder need to do in order to get this going? Like, what would your requirements, or what's the platform requiring, or in order to kickstart all of this, how much work is there involved with the founder?
So usually the first thing a founder needs to do is get SEIS, EIS, advance assurance in place. That you can prepare for that as long as you've got a pitch deck and forecast that are compatible. That the prep takes probably half an hour. What does this mean? I don't understand investor consent or information rights, whatever it is, then we are on hand to discuss that. Usually, but yeah, to get SEIS and EIS prepped is usually half an hour. And in the process of doing that, we have to produce your shareholder agreement and articles. So actually, at the point you've got your advance assurance being submitted, all of your funding round legals are ready to go in any case, because we've had to produce those to get those documents. So genuinely, I know funding legals feels, terrifying if you've never been through it, but our job is to make that as unterrifying as possible.
Somebody's asking your thoughts on a particular business, but I suppose you're not really, I expect you're not going to be able to give those live, are you? I don't know. What are your thoughts on Burn Capital? They're currently the largest SEIS fund, but are they any good for founders? You talked about the SEIS funds already, didn't you?
Yeah. So look out for, talking specifics is probably harsh, but look at the standard things we've mentioned here. Look at fee structure is a massive one with funds. Usually it's 10% fee, which is much higher. You'll pay it than anybody else. Look at rights and controls they'll want around investor consents, investor directors. Look at how they're going to treat your director's loan account. Watch out for creating the 10% option pool before a funding round, which is to your detriment as a founder. Most of the funds use most of those terms, and it's expensive capital going to SEIS funds. In general, there are some good players out there, but most of them are the most expensive way of raising.
Interesting. Thank you for sharing that. Under Tier 4 visa, I'm not allowed to establish a company until I graduate and change the visa. Will I be able to chase funds for my project?
A company, nobody's investing in you. Certainly not under anything with angel investors won't touch it unless it's incorporated in its SEIS, EIS. It feels like a great opportunity to bootstrap and get some traction. And then when you can incorporate and fundraise, I suspect you'll be further down the line, your valuation will be better.
And also you can start building those relationships from day one, can't you?
Yeah.
So all about relationships as well. An angel has verbally agreed to invest in my company that's been trading for 2 years. I've not been looking for funding, so this was a surprise. I've been tasked with confirming the ask and getting legal financial advice. A mentor from NatWest has advised I sort out an investment agreement, but he also said I should check whether the angel requires SEIS. I think most angels would want SEIS. Yeah. I think one of the things I would just say from my perspective, if I was going to advise a founder, and I'm not advising on the legal thing, but people can say that they want to do things and they want to get involved, but then you go down this path of a lot of work of trying to value your company, applying for SEIS, paying for legals, and you've actually got no commitment from this angel that they're going to go ahead with it. And it feels to me there's a lot of people that say that they want to get involved in things, but that doesn't actually follow through. What's this angel actually going to give you? And have they actually done other angel investments? And I would definitely be wanting to do my due diligence on that angel investor. I'm not sure what your thoughts are on that, Sam.
Yeah, I think DD on angel investors is very fair, and yeah, the angel's going to do DD on you, and I think reciprocal's fine. Yeah, it sounds like you should be able to get to the point of agreement with this investor without spending a penny. So you can produce and download a term sheet from our platform for free, for nothing. And if you get to the point of them signing the term sheet, then you can hurriedly get SEIS, EIS, advance assurance applied for, and by the middle of March you should have that. So there's no big barrier to entry in terms of cost. Now, if they sign the term sheet and they say they're ready to go, you start incurring fees, and you've still not got no guarantee the angel's going to invest. But if that conversation has probably turned your head to investment now, so having advance assurance in place is probably a good thing anyway. It sounds like you've been trading for 2 years. Just watch your timing, because you can only raise SEIS in first 3 years you start to trade. So make sure you don't run out of time there if you want to make use of that.
Such a good point. I have an investor who wishes to invest now off the basis of a discount of a future valuation. Is it possible to close a mini funding round with that without doing an ASA?
No, the only way to defer the valuation conversation or offer a discount is because you don't know what the future valuation is going to be. The only way of achieving that's an ASA.
I think we
that's the only good use case of an ASA to my mind.
Two more questions. I was under the understanding that for SEIS to get the tax back in the financial year, you would need to have spent 70% of the money invested, or 4 months or so have passed since the investment is done. So how could the investor get the tax back within this financial year now?
Yes, that's not true. So the investor is claiming against the year they invest, not the year that you file an SEIS 1 or they file the SEIS 3 with HMRC. Or to put that in layman's terms, it matters if I put 10 grand into a business now, it doesn't matter if it's 10 months later when you've been trading for 4 months or you spend 70%. It matters when I put the money into the bank. Yeah, okay. So that's really straightforward. Yeah.
And last question from me. I recently found out that any funds received from Innovate UK are deducted from the 250k SEIS allowance. Is there a best way to approach angels if this is the case?
So that is a question around something called de minimis state aid. The £2 you can raise under SEIS itself is classed as de minimis state aid. And therefore, if you get, say, £50,000 under Innovate, then that comes off the 250 you can raise under SEIS. Now, there are a couple of points on that. Firstly, not all of the money that Innovate gives out is de minimis state aid. Some of it is something called notifiable state aid, which isn't de minimis state aid. And therefore, it doesn't come off your 250. Secondly, if you still need to raise 250, even though you've only got 200 because you've lost 50, you can then move straight into EIS. So you can raise 250 in what's called a dual round, 200 SEIS and 50 EIS. So it doesn't preclude you from raising 250, but yeah, de minimis state aid does reduce the 250 by whatever you've got under that de minimis state aid.
Fantastic. We've had a brilliant time. Thank you everyone for coming. So I just wanted to say thank you very much, Sam. That was fantastic. You enjoyed it as much as I did. And thank you to everyone who also stayed on